Welcome, David. I'd like to introduce everyone here to David Hunter, who runs his business, which is a contrarian research business. David is a long-time Wall Street pro who produces excellent work. He'll tell you all about it in a moment, and he can tell you where to subscribe to his work. I'm Alex King. I'm the founder and CEO of Sestrian Capital Research. We're an SEC-regulated investment research business. You can find us at our website and on YouTube and on Twitter. Personally, I subscribe to David's work. I love it. Never miss an episode. And I was delighted that he agreed to join us today to talk about his view on markets in the coming year. So welcome, David, and thank you.
Yeah, thanks for having me on, Alex. First time, and it's a pleasure to meet you.
You too, you too. Maybe, David, you could take a moment to tell folks about your background, what you do now, and most importantly, where people can find your work if they want to read it and sign up.
Sure. Yeah, I'm 51-year pro, so I got in the business in 1973, just prior to the Nifty 50 top, and came out of a Midwest college, didn't have access to Wall Street easily, so I took a job in my college town working in an investment department as number two guy in basically countywide bank. Back then, that was all Indiana had. You couldn't expand beyond the county, so it was a fairly progressive bank. They had a lot of Chicago and Indianapolis bankers running it. So I was fortunate to work for a relatively progressive young guy and learned a lot. Spent 4 or 5 years there. Moved on to a bank out in Connecticut where I'd grown up. In the trust department, I had to choose between bank portfolio and trust portfolio because in the smaller bank, I did both, and it was a great experience to be able to run, asset liability management, manage a bond portfolio, and also have access to equity management. So I had to choose between the two. I loved them both, but I said my ultimate love is equities. So I went to trust side, spent another 4 or 5 years in banking there in a bigger regional bank. But needed to get out of banking. It's a great training ground, but not where you make your living. And was fortunate to be offered the equity position, in-house equity pension fund manager for Textron, which is a Fortune 100 conglomerate. They had pulled all their money out of the banks back in 1975 or 6. G. William Miller, who went on to be Fed chairman, was chairman then. And when I came in, he had already left to be Fed chairman, but his ghost was there for my whole time there. I would hear from all the senior guys on the investment committee, Bill told us never to get crazy with equities again. We should be very careful of equity because he said he never wanted to face his senior management that were close to retirement and tell them they lost half their pension retirement. So they had brought it in-house and did most of their work in kind of what they did in the conglomerate, in the company. It was private placements, fixed income, and very selective equities, almost private placement equities that weren't real popular on the street. But they missed the oil rally in the early 80s, in 79 and 80, and their top quartile performance dropped down to the second quartile. So they brought me in. I was warned by the street guys that covered me, said, don't go in there. It's dead end for an equity guy. And I said, I think I can, carve out my niche there. And long story short, I had top 1 percentile performance for my 5 years there, took them from 10% in equities to 50%, kicking and screaming, all the way. But because of the performance, they kind of went along, step by step. I was always frustrated. I'd ask for 100 million, they'd give me 50. And my boss, who chief investment officer would say, you did great. You don't know how hard that is to do. You shouldn't be. But I was 30 years old, and it was like I wanted to go. And so, but we hit the road running. I went in December of 81, and basically for 6 months said, keep your powder dry. We're in a bear market. We hit the ground running in August of 82, which was the bottom of the bull market that I think is coming to an end this year. It's a secular bull market that I think started back then. I went from there, got recruited out of there to Fidelity, ran pension. I was in Fidelity International running U.S. money in global companies. So I had Rolls-Royce as a client, I had British Leyland, I had some Australian accounts, etc. Um, and then went from there to the head of active equities for ITT Hartford. Again, another conglomerate that had bought the Hartford, which is a our big insurance company, both property, casualty, and life. It was kind of the similar story to Textron in that they had gotten out equities to offset their property casualty down cycle in the 80s and missed the bull market and brought me in. They were in some passive equities, but they brought me in to build a new equity shop. They literally were the largest equity shop in Hartford, that was a big insurance area. They liquidated it all, brought me back in to do that. So I saw it as similar to what I had done at Textron, and it was more my style. So, and then I was a chief investment officer at one point in New York. Second half of my career, for a number of reasons.
That's just the first half, right?
Yeah, it was just first half. Second half of my career has been spent as a macro strategist, and I feel that first half sets me up as a macro strategist, unlike most strategists out there. You know, most of them don't have that money management experience.
Absolutely. So, I mean, I think in a world we have now where, everybody is an investing expert, right? So the advent of social media is terrific. It makes a route to market very, very easy and cheap for professionals like yourself and like our own business. But it also means that the barriers to entry are zero, right? Anyone can publish an opinion, and unless you know what you're looking for, any opinion is as good as anybody else's until you actually start to get some skill yourself. And so, people I always like to talk to and listen to and learn from are folks who have run money, and who have run money for a long time in different market environments and for different clients, where the expectation of what happens with the money is different. My own background is, before I launched Cestrian, is in quite a different world, actually, venture capital and leveraged buyouts. And so learning public listed securities when I started investing my own capital was a journey of discovery. And the fundamental analysis that you learn in leveraged buyouts in particular is useful, if you like, necessity, but it was really once I learned technical analysis and learned to join together fixed income, commodities, equities, volatility strategies, options, all of that's when I started to get to be really successful at what I do with my own capital, and our own business Cestrian has gone from strength to strength as a result. So I'm absolutely delighted to talk to you, David. Thank you. Maybe just before we get started, one word: if people want to read your work and subscribe to your absolutely superb publication, which is very cheap, I should add, where will they find it?
Sure. I am on Twitter, or X, every day, and typically replying to other people's comments about me or about the markets. Mostly about me. Sometimes it feels like, but I also occasionally will put out an original tweet. Certainly, my interviews go out as originals, but there are people out there that think I'm only on occasionally because they are set up to only see the original tweets or original posts.
We'll include a link to your X handle in the recording here that people can look up to.
Okay, yeah, thanks.
We'll pop it on Twitter as well.
And then my other communication is through my quarterly investment letter, and it's a macro letter based on my 51 years, based on I talk about cycle analysis, and people think I'm talking about time cycles. My cycle analysis is all tied to the economic cycle and the market cycles that go along with that. So I put that out quarterly. I have an annual subscription rate for that. It's not for everybody. Certainly small retail will find it a little expensive, but as you say, for 51 years in this business, and I think I'm as good a forecaster as there is out there, it's not expensive.
My own view is free research turns out to be very expensive because of what the decisions one can make as a result of free research. And if one is selective and finds the really good stuff like your own, then I think it pays for itself in no time. Anyway,
there is, just real quick, there's so many people out on X that don't have any investment background. They've learned how to read charts, and they follow Elliott Wave or some other thing,
Yeah.
and they put out stuff and charge you, whatever, $100 a month or
Yeah.
what, and people
Yeah.
think they're getting a bargain.
That's right.
And the
That's
problem
right.
is they're getting people that have no background in this and are,
Yeah, they're learning on the
as I
job.
say, there are lots of opinions out there. There's very few informed opinions.
Yeah, I would agree with that. So I've seen a number of your videos recently, and you very clearly communicate your views on where equities and fixed income and commodities are headed. And I don't propose to go into that in great detail here because there's a ton of great content you've already put out on YouTube. But for our viewers and listeners here, maybe you could just summarize. If you look over a 1, 2, 3, 4 year horizon, keep it tight, and just very broadly direction you think of equities. When I say fixed income, I really mean government bonds
Sure.
or bond-based ETFs like TLT, and then think about commodities, by which I mean oil and metals. And just
Sure.
very broadly, those three groups, broad
Yeah.
direction of travel. What's your take?
Yeah, I have, and people think I'm somewhat schizophrenic because I have both the most extreme upside and the most extreme downside forecast for the next couple of years. I think we're in the latter stages of a 42-year secular bull market. So we're close. If you're trying to pick the top of a 42-year cycle, if you can get within a year, you're probably doing pretty good. So I think we're less than a year out. We may be less than 6 months out from the top. So by normal stands, I would be saying, nobody's that smart. You got to realize the other side of the mountain is coming and it's going to be big. So but the problem is in this last stage, it can go parabolic. It can cover a lot of ground in a short period of time. If you say, hey, I'm not smart enough to know the top, I'm getting out here, psychology is going to have you coming back in
That's right.
at the top. So
The Druckenmiller
yeah,
moment.
that's what's hard is timing wise, we're close.
Yeah.
Runway wise, I think we're maybe 30, and in small caps, maybe 45% away from a top. That's years of returns typically.
That's right. That's right.
Just know that, and people have to kind of make that decision for themselves how close they can call it. But so I think we have what I am known to be saying is a melt up into a top. And I think we've been in the melt up for the last year and a few months since October of 23. Doesn't mean it goes up every week or every month or that we don't have consolidations, but we're in the steepest part of this bull market.
Yeah.
And I think it's going to get steeper into the top.
Yeah.
Following that, I am calling for an 80%. I don't know whether it's going to be 70%, 80%, 65%, but I think the potential there for an 80% peak to trough decline in the market as a result.
By which you mean the S&P, for instance?
Yeah, I think it's going to be across the board. So it can be the NASDAQ, S&P, Russell, the Dow. Some are going to be a little more than others, but it's going to be a broad-based sell-off, bigger than any we've seen in the post-World War II era. So, I'm not going to be smart enough to pick exact percentages, but that just gives you a sense of how big it could be. And it's because I think we're heading for a global bust, and I use bust to define define bust as something bigger than a recession, but at the speed of recession. So it's not a depression because it's not drawn out.
Yeah.
It'll be a lot like 2008-9, except I think we go further because of what's happened in the last decade and a half.
Yeah.
You've got policymakers that are going to be more reluctant, particularly central bankers, are going to be more reluctant to react because they've been preached at, and they believe themselves, we can't go back there again. We're not going to print money like we did last time.
Yeah.
It's going to be necessary to print that money to pull us out of the bust, but that delay in doing so is going to end up causing a deeper decline, deeper unwind in the economy. And what I think really makes a bust is the financial side. It's going to be a huge financial crisis.
Yeah, interesting. Okay. And if I were to ask you what would cause the turn, so from my own perspective, I agree, nobody can call the top two at the T. It's impossible. But you would look at the the rapid ascent of equity markets in the last decades, and in particular since the inflection point in 08, 09. And so most Western economies have not grown particularly quickly. Not the US, not Europe, not anywhere particularly quickly on a GDP front since that time. Absent inflation-led growth, which has been a response to money printing basically. So I feel like a fantastic trick was pulled, a really effective trick was pulled in 2008 with the QE and everything that went with it. That's been really effective at kicking the can down the road as regards risk asset prices. It's been pretty tough on anyone who sells their labor, their time for a living. Inflation has really eroded what you get, the purchasing power you get for selling an hour's worth of labor. And it's been a terrific time to be in the asset owning class versus in the labor selling class. So it feels to me like whenever a turn comes, it's sort of because that particular party trick is going to run out of road. And I'm not sure that anyone yet has figured out what the next party trick is, whether it's just another heavy round of QE or some other creation. I don't know, but it feels like that particular trick is sort of coming to an end. And when it does run out of road, the tide will have gone out, and the slow GDP growth, increasing divergence between rich and poor, not wonderful earnings growth outside of the top companies. I feel all of that will suddenly become apparent, and at that point, then the tide's out, and then we may have some problems. When that is, I mean, your guess literally is better than mine, I'm sure. But that's how, those are the things I see, sort of, the structure beneath the surface that are storing up risk.
Yeah, well, what I say is because obviously we have a new administration here in this country, and they're very pro-growth. I think they mean business in terms of cutting costs in the government, getting government size down somewhat. There's going to be a lot of pushback against everything they try, but we've been at this since the Great Depression. We've been building this thing up and building it up to the excesses we have now, and that's part of why we're going to have a bust. A big part of why we're going to have a bust. But so I would be, in normal times, I'd be very encouraged by this new administration. Say, we have, as he talks about, a great new frontier ahead. The problem is these excesses have been building for 80 years, and they just, as I say, the macro is going to trump. And so, and that's what I think is really why I'm pretty confident that everything's going to be kind of speeded up into a pretty short next cycle after the bust. Mm-hmm. It's going to be driven by massive money. If we did, people don't remember, we had 875 billion was our Federal Reserve balance sheet in 2008. It went, after the great financial crisis, it grew, by several trillion, mm-hmm. And then grew up by another 5 trillion in the 2020 period because of the pandemic.
Yeah,
I mean, and people don't stop and say 875 was what we'd been since 1913, was the largest we'd been. And then all of a sudden, in a decade, a little more than a decade, you're up to 9 trillion. Yeah. And if people think that's crazy, I think you're going to see 20 trillion as what's going to be necessary to pull us out of the bust, or what they're going to do. It may not be, because it leads and lags, probably more than they should have done. But that's gonna be why we have one more cycle. I say there are plenty of people out there, particularly in the Austrian camp, that think we're at the top now, we're going to go straight down, and this is the next Great Depression, and the Peter Schiffs of the world. The difference between somebody like Peter Schiff and myself, there are probably many differences, but one big difference is, because of the printing press, we have one more cycle. He believes it's the end. I believe the end comes in the 2030s. So but I do think it's going to be, because of massive money like that, it's not going to be a consumer driven cycle, but it's going to be a very big inflationary, industrial driven cycle.
Yeah, I mean, that the inflationary impulse that would come from that would be, more crushing than anyone has talked about in the inflation so far. Right? I mean, we have two economies today. We have an asset owners economy and a labor sellers economy, and that
Yes.
seems that's going to
Ima- Imagine what consumers going to face
yeah.
if you get 20 trillion. You're going to, I'm talking about the potential for 25% inflation in this country within, maybe the end of this decade, early next decade. If you get that kind of inflation, you're going to have 20% interest rates, short rates even above that, and long rates close to that. There's no way, and again, this is around the world, so I'm talking US, but around the world, there's no way that you can service the debt we're going to have. We can't service it at 5%. So how are you going to service it at those rates? So that's the recipe for the disaster, to follow.
Yeah. So we talked about fixed income and commodities. So you think equity curve is basically, up. And I would agree, when tops come, you tend to get a blow off top, because everyone's afraid. Even sensible people who've stepped back and said, well, I'm not at the top and I've got out, I'm safe. There's that Druckenmiller moment where you dive back in, wish you hadn't. So pure psychology can drive that. I agree. How do you look at fixed income? Again, I really mean government bonds, and how do you look at commodities?
Yeah, I think government bonds are going to be one of the very few assets to hold up in the bust. Mm-hmm. So if you're talking about 8% down in equities, you're talking about commodities dropping, even gold's going to drop because you're going. I think the bust is probably going to be for a short period of time a deflationary bust.
Yeah,
and I'm not just
so money's going to rush into government bonds. You would expect.
So yeah, it's the one place, particularly U.S. government bonds. I can't speak for all of the world, but certainly U.S. government bonds. I think as I say, I'm not worried about this cycle for the government defaulting because they have the printing press. Next cycle with inflation, they won't have the printing press. But this, and that's why I think you'll get a collapse. But this cycle, there's no default coming. So, and it probably holds true around the world, that all the printing presses will be working. So that will be one of the very few assets to hold up. I think the 10-year can go from the current 450 down to zero. I think short rates may go negative in this country as much as Powell says no. They're not going to be in control of that. And if you're printing $20 trillion or doing QE to the tune of 20 trillion, that means you're buying up every bond in sight. So, and of course, there's going to be fiscal to accompany that. I don't know whether it'll be to the tune of 20. It'd probably be, half of that or 15. But they'll be coming up with every program they can come up with. People don't realize the central bankers and the government policymakers are going to be like deer in headlights, staring at a free-falling financial system around the world and saying, what do we do? They can talk intellectually all they want about we're not going back there. When push comes to shove, that's when
I mean, anyone watching this who is either new to investing or is just young, this all sounds very dramatic, but it's not really. It's a boom and bust cycle. So people were paying 15% plus interest on their mortgages in the 80s. The 10 or 15% mortgage was not unthinkable then. And so the current, people talk about 5% rates being high at the moment. Now is the anomaly. It's not that 10 or 15% was the anomaly. Now is the anomaly. And then, I remember watching, I was in, say, leveraged buyouts at the time. I wasn't in public securities, but I remember watching 08, 09 play out and thinking, well, there's a whole lot of smart people going, I wonder if this is the end of Western, liberal democratic capitalism. And they weren't, in some kind of funk. They weren't, imagining it. That actually was a question that was being asked. And there were a number of mechanisms that got brought in to solve that. Global coordination, government, private sector coordination, all of that. But it was a legitimate question. And all of that was off the back of the same thing, which is credit excess, in that at that time, mortgage and other forms of private credit. So it's easy to watch views like yours and go, oh, it's just apocalyptic nonsense. That'll never happen. But these sort of questions do come up every couple of decades. It's just a function of human psychology. And
people don't realize how much leverage matters.
Right.
You lived it, in hedge fund, but leverage works great when everything's going well.
Right.
When
Leverage
it
is
goes
fantastic
bad,
as long
you
as
don't
you're
have a
levering
choice.
something that's
You have
pointing
to
in the right
liquidate.
direction. Leverage is
Right.
great. Yeah. I mean, the one thing that strikes me, another source I think of a future retail crisis probably is everybody, now loves single stock levered ETFs, right? And three times levered index and levered commodity ETFs. And we use them. I use them personally, and we use them in our research service. But we use them in a hedging environment, right? So we teach how people can use them to make money on the downswing, to hedge their exposure, and to reduce risk. But I feel that that's a minority pursuit, and I feel we're going to see a lot of people in the next year or two who have got very, very exposed to long only, three times leverage. Lots of those funds have relatively limited assets under management, and so when the worm turns, as it will eventually, there's going to be a lot of problems in that sector, I think. And then we'll see a whole sort of set of, well, I never should have been allowed to buy these things in the first place type of complaint. And
Yeah.
so,
Well, from an even bigger perspective, I think I call derivatives leverage on the markets.
right,
And
yeah, sure,
we've got quadrillion the notional value of
right,
derivatives.
right.
People know we have 320 trillion in global debt. They don't really think about derivatives as leverage, but I think it is why I think we'll see huge market swings.
Well, I agree. And again, just to make the observation that anything of this nature is not, in fact, some sort of apocalyptic that could never happen. Again, in 08, 09, what was it that caused the structure to start to crack? It was derivatives, and it was derivatives where the counterparties couldn't be found, and where the whole notion of collateral to sit under those derivatives, had been sort of an amusing joke for 2 or 3 years until it wasn't. And so that's right.
It,
I agree.
it's great. It's great when the music's playing, but when the music
Exactly.
stops, there aren't
Yeah.
enough chairs.
Yeah. So let me ask you this. So let's say you were sat, in the middle of the Fed, in the middle of the White House, and you said all this, and you were taken as seriously as you should be. None of us know if this is definitely going to happen or when it's going to happen. Of course, we don't know that. If any of us can forecast next week accurately and do that with reasonable level of repetition, we can all become very rich. We don't have to see the future years out. But let's say that this does prove correct, and let's say that your analysis was taken seriously at the very highest level. If you're on the other side of that, if you're a policymaker on the monetary and on the fiscal side, what are some sensible responses that people could take?
Yeah, it's so hard because of the leads and lags that
That's right.
I don't even think these hypotheticals are realistic, because even if I were sitting there, the pressures on Powell
Right.
to do the right thing, I don't think he sees what's coming. He doesn't understand the magnitude of risk. People go, well, he probably knows what you're talking about, but I said no. He has no he and no policymaker and no politician has any clue of the magnitude of the risk that's built up here, and how fast that can unwind things. So first of all, I don't think they're there. But even if I was there and I had the pressures on the person in that role, it's I mean, you've been a money manager. It's the same pressures of trying to go against the massive psychology
Right.
when you think something but you can't prove it and you can't know it, and to go out, and I do it as a contrarian all the time, but to go out on your own against all of those pressures
Right.
in a policymaker stance, impossible. I mean it. So
Yeah.
I become a defender of Powell even in this last year. I think he's going to be, policy error is going to be part of the bust.
Yeah.
But even so, I find myself constantly battling people on X who want to call him evil and this and that, and I go, actually, Powell's been more right than I have. I mean,
Yeah.
he's I've been saying this thing could happen sooner, and I said in their role they're doing you couldn't have done it better than he's done it, basically, given how this thing has come along. The problem
Yeah. I mean,
is the
yeah.
problem is at some point there's you're not going to get warning and it's all of a sudden going to go the other way, and you're going to say,
That's right.
well, they were too, in hindsight they stayed too tight too long. That's my thesis anyway.
I think one of the problems is there is a big difference between if you're running money, ideally your own, but if not your own, then some clients who trust you. then you've got a degree of freedom and independence that it's impossible to have in any employed job. Be that the most junior of investment manager, or be that the chairman of the Federal Reserve or the president of the United States. You have so many interlocking pressures at policy level that it's awfully difficult. I agree to go with anything other than the current grain. And the nature of market cycles, because of the nature of human psychology, is that everything always swings too far one way and then back the other way. And so I tend to agree, which is as many problems as anyone tries to solve right now, market cycles happen. Right? They're unavoidable because of the psychological factors that cause.
And basically, the market's in charge, not
That's right.
Paul,
Absolutely. Absolutely. That's absolutely right. David, I really, really enjoyed talking to you. It's great to get such a refreshing view. I hope people will listen to the nuances of your opinion. I mean, there's any number of perma bears you can go and find all over social media. I ignore them. It's not very interesting to listen to. We can always any of us can call a crash tomorrow, and there's anyone that can call, parabolic up tomorrow. That's not very interesting. What always interests me is people who aren't wedded to any particular view, but have a good track record of, prior to a market taking off, saying, well, I think we're going to switch to a bull face soon, and prior to a market going to decline, saying, I think we're going to switch to a bear take soon. And there are very few people who can do that, and you're one of them, which is one of the reasons I love watching and reading your work. So I hope people will seek out your stuff, sign up for your newsletter, which, it might look expensive on the surface, but I can tell you, as a long-time investor myself and someone who publishes investment research, it's a very good value piece of work. And I don't miss one. I love watching it. I love reading it. So thanks again, Dave, for joining us. And I hope to speak to you again very soon.
Yeah, thanks, Alex. Appreciate it.
All right. Talk to you soon.
Bye now.
Bye.